Who likes to pay taxes? You like to pay taxes? I don't like to pay taxes. So I try to avoid taxes as much as I can. We're going to talk about one specific tax exclusion from the profit on the sale of your house. Hey everybody, and welcome into another episode of the Real Estate Minute Show. We're going to talk about taxes on the sale proceeds from the sale of your home. The caveat here, disclaimer, I'm not a financial advisor, I'm not a CPA. You need to get consultation to verify anything I'm talking about. This is just for informational purposes, okay? Chink, check mark. So let's say you bought a home for $500,000 and you're selling the home for $1 million, okay? You have a $500,000 gain on the sale of your house, profit, okay? Normally you pay tax on that. It's a lot of tax too, okay? You pay capital gains tax, but depending on what state you live in, you could be paying anywhere between $100,000 to $200,000. Huge. A lot of people make their decision on selling their house based on that tax bill. But I'm here to tell you, for those that don't know already, a lot of you do, but a lot don't, and I want to make sure you do know this, is that the IRS has a huge exemption from taxes on the proceeds from the sale of your home. If you file singly, it's $250,000 of profit on the sale of your home that's excluded. If you file jointly, it's $500,000. So, my example, you bought a house for $500,000, you sold it for $1 million. That $500,000 exemption, okay, applies. You have no gain, no tax, okay? And that applies to everyone, every homeowner in the United States. Now, your state may tax you, so your state may be a little different. You need to check with your state. California, where I'm in, follows the IRS guidelines with the same $500,000 exclusion, and your state might do the same. In order to qualify for that $500,000 exclusion from the profit on the sale of your house, you just need to meet two tests. You need to meet the occupancy test and the use test. And all that means, occupancy and use, is that you had to have used the home for 24 months of the last 5 years as your principal residence. So you had to have used the home for the 24-month period, any 24-month period, doesn't need to be the same block of time, during the last 5 years before you sold the house, and you qualify for the exemption. Amazing. Now, the IRS uses a facts and circumstances approach, they call it, which means that in order to determine that you used your home as your main principal residence for 24 months in that 5-year period, which could be sporadic, is they use facts and circumstances. Do you get your mail there? Do you register to vote there? Things like that, okay? So if you spread yourself around, you live 3 months at that house, 3 months at this house, you may have to prove some of that stuff up, so just be aware of that. But that's it. That's all you need to meet. And $500,000 comes right off the profit of your house and you don't pay tax. It's really amazing. And it's really affecting people's decision. People finding out about this exclusion is affecting their decision whether to buy or sell, because they can say, holy crap, honey, I didn't know that we can leave here tax-free. And they put their house on the market. And this will help kind of increase inventory over time as people get educated about some of this stuff. So hopefully that helps. If you need to reach out to me regarding some of just the generalities of this, feel free. Otherwise, I recommend that you talk to your CPA, your financial advisor, accountant, etc., to get real specific, because there's some other ways to reduce additional profit as well, which I want you to be aware of. Take care, have a great week, and we'll see you next week on the Real Estate Minute Show.